Hello, this is Jordan, and this is your precious metals video market update. Today is Tuesday afternoon, September 29th, 2015. And starting off, let's take a look at the New York Stock Exchange. This is a chart that we've posted in these videos in recent months, noting the deterioration in the broad stock market and looking for weakness and how that would ultimately positively affect gold. And what we see here in this chart is we have a daily line chart of the New York Stock Exchange at the bottom, and then there's four technical indicators at the top. Also note in the chart the 400-day moving average in blue. That has been a clear indicator of trend over the last 10 years and probably 15 or 20 years. And today the index closed at 96.22. Now, just to start off, where I think this correction or bear market could, or at least where the next potential important low could be, you want to focus on 8,500. That is the 38% retracement of the bull market from 09 to 15, and it's also, if you just put a line right there, it's been a major pivot point over the last 10 years. So that is a little more than 10% lower, maybe 12% or so from where we closed today. Now, looking at the indicators up top, they can tell us when the market gets really oversold and when the risk is going to favor the bulls. So at the top, we have the percentage of stocks trading above the 200-day moving average. Below that, we have the percentage of stocks trading above the 50-day. And then the third one is the number of new 52-week lows on the New York Stock Exchange. Now, let's start with the one up top, the percentage of stocks trading above the 200-day moving average. It's at about 17 to 18%. As of yesterday, it hasn't updated yet for today, but maybe it'll go down 1% or stay where it is. But anyway, when that gets close to zero, you have a very important market low. And by close to zero, we're looking at 10% or even less than that. We can see in 2011 at the two lows there that it appeared to touch 10% twice. Obviously, in late 2008, that was below 10%. It was 0 to 10% for several months before the market bottomed. But anyway, we're at 17% right now. And so to really give the risk back in favor of the bulls, I want to see that this at least come down to that red line, which is about 9 or 10%. When it gets to 10% or below, then you want to be nervous if you're a bear and you're short. Now, the 50-day moving average, that's obviously a lot more volatile. That's at a reading of 14% right now. In August, it bottomed. I don't know where, but I'm guessing. I'm pretty sure it was below 10%. So again, that's at 14% right now. If that goes below 10%, the market's going to get very oversold. Then a third thing you can look at is the number of new 52-week lows, and I drew two lines there from about 400 to 600. You can see this when it spikes like that. That tends to coincide with an important low. As of yesterday, it was at 296. So in the next couple days, if we see that spike above 400 or 500, in addition to the top two indicators going to 10% or below that, then you have to know that the market is really getting oversold and you should look for a bounce or a sustained rebound for a couple weeks. So that's something I'm focusing on in the next couple days. Now, moving to precious metals, we have gold plotted at the top. This is a daily line chart. And below gold, we plot gold against global equities. That's the ACWI, all country weighted index. That's an ETF. We plot it against the New York Stock Exchange and then emerging markets. Now, we know that gold has already broken out against emerging markets. So let's focus on the top two. And something we pointed out last week, when you're looking at a weekly chart of this and the 80-week moving average, those two ratios closed above the moving average for the first time since late 2012. So it was the first time in 3 years. So that was an important, using breakout is a little bit too strong, but that was an important break in gold's favor. These ratios are really starting to turn in favor of gold. And the next thing that we want to look at, you see the red resistance lines there in those two ratios in the middle of the chart. If we see the ratios break that resistance and surpass the January 2015 highs, then the ratios will be at a new 52-week high. So the next move higher to come, that's going to be very, very significant. If it indeed breaks out, makes a new 52-week high, then we really know that the situation between stocks and gold has really changed. It's flipped in favor of gold if that happens. And at the same time, we're watching that closely in addition to gold, and to see if gold can make a potential final low below 1080. You can see there's very strong support around 1,000. To be specific, it's from about 970 to 1,000. So that's an area where I could see gold bottoming in, and of course 1080 is the key support. So these are two very important things I'm watching: the gold chart, and then how gold's performing against stocks. And again, the latter is really starting to trend in the right direction for gold. Now let's move to the miners. This is the bear market analog chart, updated as of last Thursday with the Barron's Gold Mining Index data. This is the worst bear market ever. It's extremely long in the tooth, but it's possible it could last a little bit longer in terms of price and time. Now, I also have one of these charts for the Huey Gold Bugs, which I have not showed yet, but in terms of price, the bear market is about exactly as bad as it was for the Huey from 96 to 2000. And looking at that chart, it also shows that the bear market could last a couple more months, as you see with this chart. So keep that in mind. Now, why do I say it's possible that this bear in the miners could last a little bit longer? Well, first of all, as we talked about a couple slides ago, gold is not ready to bottom yet, obviously. I mean, if gold had already bottomed, you'd see the miners performing much better. So gold, it looks like it could bottom in that 970 to 1,000 area. Obviously, it's far from that right now, but it can get there quickly. But the fact that the miners haven't been able to rally yet, that's probably because gold hasn't bottomed. That's just one opinion. But anyway, looking at this chart right here, 3 to 4 weeks ago, I noted that in the weekly chart that it was not a double bottom, and not to expect a big rebound in the miners. Even in recent days, I've seen a lot of people, even a couple I respect, noting that it's possible the miners could rally. I noted this over the weekend in my update to premium subscribers. If you look at GDXJ, very strong confluence of resistance at 22 to 23. Same thing for GDX at 16 to 17. But you can see that this rally is really, or this attempted bottom, or whatever you want to call it, it's really fizzled out in favor of the bears. I mean, it's all but failed at this point. And the fact that the miners weren't even able to rally up to that resistance that I just noted, that's bearish, and that tells you that it's probably going to break lower and make a new low. And so you really could see, you have to really prepare yourself for a final breakdown here, and perhaps that could coincide with gold breaking below 1080. I mean, it's possible that the miners could bottom before gold. So that's something to keep in mind. I mean, as far as when do I want to be a buyer of my favorite juniors, I want to see the miners breaking down to new lows. I want to see gold below 1080, and I want to see sentiment indicators, the COT, put call ratios, discount / premium to net asset value. I want to look at those things and see them indicate extreme pessimism. They're not indicating that right now. I mean, over the last 2 months, what you've seen with the miners and also silver is they've basically kind of gone sideways. Sentiment was extremely bearish in July. Gold held 1080, and we've seen a rally, but the miners and silver have just been way too weak. All they've done over the last 2 months is basically kind of go sideways. The bearish sentiment has been unwound, and so it could be setting up for that final break lower. So bulls and bears, you got to be aware of that. You got to be prepared. Couple last things here. We're giving away our book for free, The Coming Renewal of Gold's Secular Bull Market. Go to thedailygold.com/book and follow the instructions, and you'll get the book. It'll be automatically emailed to you. You can also, if you're watching this on palisaderadio.com, just point your mouse just right at the top of the website, enter your email there, and you'll also get the book for free. So, if you're watching this on Palisade Radio, just go to the top of the website and enter your email there. Lastly, you can follow more of my work at thedailygold.com. You can sign up for my free newsletter there. We also have a premium service. That's all for today. Thank you so much for listening and watching, and I wish you all the best in the days and weeks ahead.